Millions of American families did everything right. They saved, they bought homes, they paid their mortgages every single month, and they still lost everything because the entire system they trusted was a fraud. The FBI called it an epidemic. They weren't wrong. Mortgage fraud didn't just wipe out individual families, it wiped out entire neighborhoods, entire cities, and trillions of dollars in wealth that ordinary people spent decades building. So how did it happen? Let's go back to the beginning. In the early 2000s, owning a home felt like a guaranteed path to wealth. Home prices were rising every year, banks were handing out mortgages like candy, and the sales pitch was simple. Buy now, prices will keep going up, you can always refinance later. It sounded like a sure thing. It wasn't. Here's what was really happening behind the scenes. Banks and mortgage brokers were handing out what they called stated income loans, but insiders called them something else, liar loans. Borrowers could qualify for huge mortgages with almost zero verification, no proof of income, no real scrutiny. Brokers got paid for every loan they closed, so they had every reason to push people into loans they couldn't actually afford. But it gets worse. These mortgages were engineered to explode. Lenders offered teaser rates, low payments at first, then the rate would reset to something much higher. Families were told, don't worry, you'll refinance before that happens. What those families didn't know was that by the time the rate reset, refinancing would be impossible. And then Wall Street got involved. Here's where the fraud went from predatory to criminal. Banks took thousands of these toxic mortgages, bundled them together into something called mortgage-backed securities, and sold them to investors around the world. Rating agencies, the companies paid to tell investors how risky something was, stamped these bundles with AAA ratings. The safest possible investment. Except they weren't safe at all. They were ticking time bombs. The same garbage mortgage could be pooled, sliced up, repackaged, insured, and resold over and over again, so many times that nobody even knew who actually owned the risk anymore. The FBI had warned about this in 2004, a full 2 years before the bubble peaked. Federal investigators said mortgage fraud was becoming an epidemic. Nobody stopped it. By 2006, home prices started falling, and when they fell, everything unraveled at once. Families whose teaser rates reset couldn't refinance because their homes were now worth less than their loans. They couldn't sell. They couldn't keep up with the new payments. Foreclosures exploded. At the peak, millions of foreclosure filings were happening every single year. Now here's the detail that makes this a crime, not just a crisis. During what became known as the robo-signing scandal, banks were processing foreclosures so fast that employees were signing hundreds of documents a day without reading them, without checking if the paperwork was even correct, without verifying if the bank legally owned the right to foreclose. Families lost their homes based on documents that were never properly reviewed. Some of those foreclosures may not have been legally valid, and yet they happened anyway. By the time the dust settled, 8.7 million jobs had vanished. Household wealth across America dropped by trillions of dollars. In some cities, home prices fell 50% or more. Entire neighborhoods turned into ghost towns of vacant, foreclosed properties. And those empty homes dragged down the value of every house around them, hitting even the neighbors who never missed a payment. Former TARP Inspector General Neil Barofsky said it plainly. Powerful institutions were protected far more aggressively than ordinary homeowners. The big banks got bailouts, executives kept their bonuses, almost nobody went to prison. Meanwhile, families who lost their homes faced destroyed credit, no savings, no equity, delayed retirements, and the kind of financial trauma that follows you for a generation. The fraud wasn't hidden. The FBI saw it, regulators saw it, the Senate called it widespread failures in financial regulation. This wasn't an accident. It was a system designed to extract money from ordinary people and transfer it upward, and it worked perfectly until it didn't. Here's what stays with me. The families who got hurt the most weren't the ones who were reckless. They were the ones who believed the system was honest. They trusted the lender, the broker, the rating agency, the bank. That trust was weaponized against them, and if it happened once, it can happen again. Follow this channel, because the next time someone tries to sell you a sure thing, you'll know exactly what to look for.